Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Not sure I'm worthy of that introduction. That was a good one. Like that. Hey, welcome to today's show. Feel free to call us 216-901-0945 if you have any questions. And I would like to tell everybody thanks for coming out on Thursday. We took a small look at socially responsible investing, looked at the 10-minute retirement plan again. And that's one of the key things I think I really like to continue to talk about. It's gotten so much easier than it has been in the past, mainly because of technology, software that we have, to be able to do the calculations very quickly. It's just, it's not as hard as it used to be. It's still hard saving money. It's still hard managing your money because it's, markets are volatile. Everybody wants to make the most money that they can. Most people have a difficult time handling the volatility of markets and the changes that occur, and there are lots of things that go on and make it pretty challenging. It's one of the reasons I have a job. And I'm just looking at just the large, medium, and small cap stocks, both value and growth, over the past 6 months, and there is a 7% difference in these Russell indexes that represent large, medium, and small cap stocks. 7%. In 6 months. That's actually a pretty big number. That's a big spread. And one of the things that we like to do at Bullington Capital is just kind of tracking that stuff. I would be looking at taking some money away from the large cap, the one that's done the best, because when I look at the stocks, they're actually the most overvalued. Now, they're not super overvalued, so don't panic. In fact, I keep hearing that stuff every day. Market's going to crash. We're going to get a correction. Well, we always get a correction. That's like saying it's going to be cold in December. It's not a matter of if, it's when, and just get ready. It's okay. It's not going to be the end of the world. In fact, the economy is growing really fast. What's even more important is that the S&P 500 revenues are up first time in an incredibly long time, almost 6% year over year. That's a big deal. If revenues are up 6%, profits go up faster than sales do because your fixed costs stay fixed. When you run a business, whatever your real estate taxes, if you own the property, they don't go up because your sales go up. They stay flat. If you're renting the space, your rent doesn't go up because you made more money. Your fixed costs, they stay fixed. Most of your employees are on a salary or working hourly. You're not paying more money necessarily. Sometimes you do. If you're like I am, you do. But anyway, long story short, the fixed costs stay fixed, so when sales rise, profits go up more than they should. Now, or not more than they should, they go up faster than sales do. And this is really important. I keep hearing about, the market's overvalued, Yeah, some stocks are a little bit, maybe right around the 10, 15% neighborhood. That's not a big deal, particularly when the earnings are growing at better than 10%. So the sales have grown over 6%, earnings are growing a little bit over 10%, and this time it's not because the companies are buying back their shares. That's what's been driving earnings growth, to a large extent, over the past 5 years. This time it's coming from organic business growth, which is pretty awesome. And under that scenario, the market's not overpriced at all. It's just anticipating. It's just got built in the next 12 months worth of earnings. So as long as something unexpected doesn't happen, market's right where it should be. It should be at new highs. Think about this. S&P 500 was right around 2,000 in 2000. In fact, let me pull that up. So right around 2000, well, it wasn't. I take it back. It was in the 1500s. So it's about 100. The SPY was $150 in the year 2000. It is 2017 now, and it's only at 258. To go, that's like going from 15 to 25, and it took you 17 years. That's not a real good growth rate. That's actually a very poor growth rate. So if we hadn't had some certain things happen, I'm sure the S&P 500 would be around 3,200, and probably where it's going to be in the next 36 months or so. Let's be, I'd even give it 48 months. I think we're up for, this is probably going to be one of the longest extended bull markets in the history of the country. I think we're right in the middle of one of the longest bull markets in the history of the country. Now, that's not saying a whole lot because you're coming off of one of the worst declines in the history of the stock market. So I'm really not saying a lot when I say that. And the recovery has been the slowest recovery in the history of this. So we're really not, I'm not saying a lot when I say that. That's not, it's not pie in the sky, and it's not like the market's going to skyrocket. And I sure hope it doesn't, because this is what happens. Everybody is anticipating the correction. They're wondering what they should do about it. Well, you should already know what you're going to do about it. If you're wondering what you should do about it, you don't have a plan. So that would be the first thing I would do, is get a plan. The next thing I would do is remind myself to stick to that plan when the market's down or 10 or 15%. And if your plan doesn't include increasing your exposure to stocks when the market's down, then you need to go back and get a new plan. That's not a good plan. Trying to jump out of the way is not a good plan. Trying to anticipate the next move, not a good plan. You need to know what you're going to do no matter what happens, and then respond correctly. It's not as easy. It's not as hard as it sounds. And again, we'll talk more about that a little bit later in today's show. But back to my earlier point, market's not that overvalued. You take out the top 50 stocks from the S&P 500, and a lot of the stocks are undervalued. You look in the other areas of the market, international emerging markets doing extremely well. If you don't have that, some exposure there, it's been hurting you. The sales growth is the fastest it's been in about 9 years. Earnings growth is up, and it's always faster than sales growth, again, because what we talked about, the fixed cost remaining fixed. When your sales go up, it's good for your bottom line. I really think we're just getting started. You've got a new administration who has their hands so full with a whole bunch of other things. The business regulators probably out not having a whole lot of time. I'm just kidding, kind of. But it's a friendlier environment to businesses. It is. It's a friendlier environment to businesses. No matter what you feel, no matter how we think, it has been a friendlier environment to businesses, and that's probably not going away anytime real soon. So what am I trying to say here? What I'm trying to say is you should probably have a healthy dose of stocks in your portfolio. And even if you're in your 80s, I think you should need at least 50% in your 80s, because bonds are not going to make much money over the next 4 or 5 years. They haven't made much money in the last 4 or 5 years. Actually, they haven't made much money in an extremely long time period. And go back to the B&D. Now this is excluding dividends, which aren't a lot, by the way. But the B&D, that's the Vanguard Total Bond Market ETF. It's the same price. It's at the same price that it was in 2010. 2010. And the dividend on that thing is only it's under 3%. So, or right around 3%. So that's what I'm saying. And by the way, the worst is not yet to come for bonds. That's actually not the worst. It's going to get worse than that. And I don't want to, I'm not trying to scare anybody. I'm trying to say, hey, you want to stay away from that. You want to reduce those bonds in your portfolio. The only reason to have them to begin with is because they typically don't drop 50% when the stock market does. That's why you have them. They're not as volatile. But you got to be careful which kind you're buying And right now, a lot of your government agency-backed mortgage bond ETFs, I think, are probably the best deal on the market. You get a slightly higher yield. Principal is coming due on those bonds every month, so that they're reinvesting as interest rates do start to go up. They're reinvesting in the higher interest rate bonds. They're not as volatile, so that's a good place. And you need them to try to keep the volatility down. And the other thing that you really have to do is kind of widen your focus. Look at all the available options: large cap, mid cap, international, emerging market. You want to look at and small cap. You want to look at both styles: the growth style, the value style. Internationally, there are actually just a couple of index funds that outperform about 90% of all the other funds out there. These are all the kinds of things that we do at Bullington Capital when we put together a portfolio. We're trying to include all the categories, and we'll weight them by how we see things developing over time. And right now, we've been heavily weighted large cap. That's actually been pretty good this year. For that, momentum stuff has really been taken off lately. Boy, that has really kicked in. But it was lagging for 2.5 years. It was down a lot at one point in time. But that's how that works. And that's why you don't want to have everything in one thing. Not a good idea. If you're young and you're just starting out and you're trying to put money away, there's a equal weighted index you might want to buy into. The expense ratio is really low. In the long run, it's got a better track record than an awful lot of professionally managed funds. It's super inexpensive. You can buy it in just a few shares. So that would be something you might want to take a look at. And the symbol on that is EQAL, by the way. I'm not advising you to do this because I'm not allowed to do that on the radio. So as I think about it, give me a call, email me, bill@bullingtoncapital.com. We could actually set portfolios up for you that are similar to that. And that's a pretty good place to start if you don't know where to start. That's a really good place to start. In fact, that thing outperforms about 50% of all professionally managed funds. So you're at least in the top 50% without knowing anything. And it's lagged a little bit this year, no doubt, because this year it's really, you look at the what's done the best, and it's international emerging market, and that's just within the last 6 months. Those things have really come alive, and they're starting to move. And they should be, because they were lagging for about 5 years. They underperformed for a really long time period. Now growth is starting to pick up, not only in the United States, but all over the world. And their stocks are more undervalued than ours are. So at some point in time, and it's all about confidence, by the way. If investors worldwide are confident, everybody likes a bargain. So they go bargain shopping. What do you buy when you're buying bargains? You don't go look for the 52-week high list. That's not what you do. You go and look for those things that haven't done that well and try to figure out which ones you think are going to do well in the future, and then pick them up as cheap as you can. That's what they do. And give it a long enough time period, it tends to work out pretty well. You give it something a long enough time period, most things tend to work out pretty well. So people get a little upset when they're not in the leading fund. Well, I got news for you. You've got to have a crystal ball that works to be able to do that. To figure out which category is going to be the best category over the next year. And I know a lot of people tell you that they can do that. I see it on the internet all the time. It's just not true, and it's not necessary. And what you do is lead yourself to an awful lot of frustration by trying to do that. And take it from one who's tried more things than most people I know, and the people that I know are institutional money managers. These guys do a lot. And I've tried a lot more things than a lot of those guys. And I can tell you that trying to forecast the future is always going to be tough, because you know why? Because you're trying to forecast the future. That's tough to do. Something's always coming up that you don't expect. And incidentally, that's one of the things I really like about this particular market. You've got an awful lot of people out there that are afraid. They're really afraid. You hear it every day in the papers. You read about it. Well, you read about it every day in the papers. You hear it on television every day. You even hear about it on radio shows. Market's overvalued. Market's going to drop. Even one of my favorite websites, Investopedia, these guys are succumbing to the need to sell ad space, and they're running these ads about market crashes. I'm like, no, no, don't believe them. You get a 10 or 15% drop, you should be a buyer. And to try to anticipate that, good luck. You know it's coming. You just have to wait. That's just like the first snow of the year. You don't have to know exactly which day it is to figure out which day you're going to get your boots out. Keep your boots in the closet where you can where they're accessible. Same thing with your portfolios. Keep them liquid so that you can move them around. The stuff that we use is incredibly liquid. Don't overconcentrate. Don't try to do too much in one stock. That's the kiss of death. Don't worry if you're underperforming a little bit. You're never going to be in the top performing category except by luck, at least not with all your money. And one of the tenets of investing well in the long run is holding a little bit of everything. And I used to not believe that because you didn't have access to everything. There were categories where there was no product for you to invest in. It used to drive me crazy. They would tell us to do the asset allocation, buy large companies, medium-sized companies, small companies, and then there were no products there that actually fit those categories. So nobody could actually match the results of the models that they were showing us. And now you have so many choices to fill those gaps that are accurately represented. It's a great thing. It's great to be alive as an investor. As an investor, you have more choice than you've ever had in funds. You have fewer choices in stocks, by the way. In the last section of today's show, we'll talk about some individual stocks, things I watch coming up. Yeah, as most of you know that came out to the seminar on Thursday, and thank you very much for coming. I appreciate that. We had a good time. We talked a little bit about stocks there, and I'm always going to talk about that. I run a small fund, and I'm trying to figure out how I want to do this. I put up the website 3 or 4 times, and it's just too much work. We're a small firm. There's only a few of us there. It's too much work for us to run a full-time advisory website in addition to our practice, but I think I have a solution to that problem, and I'll be talking about that when we come back from these commercial messages right here on 1420 The Answer. You're listening to Bill Bullington. I'll be back right away. And we're back. Wow. One thing I got to tell you guys, every momentum scan I run has got so many names coming up in it that it's taking me a really long time. I'm having to get up really early in the morning to be able to run through these scans for the day. So it's been choppy, I will tell you that, but it's still a good sign that you've got so many names coming up in these scans. I think, and this is one of the times of year over the last 5 years or so when the market's put in a tremendous amount of its returns. It's really come in the last couple months. So it's a pretty big deal. I think it's very healthy over the next few months. Should be pretty good. Barring some unforeseen catastrophe, I think things are in pretty good shape. I think that things are actually going to stay in pretty good shape for the next 4 to 5 years. There are an awful lot of businesses spending an awful lot of money. That's a big deal, too, because that hasn't been happening under the prior administration. Businesses, they were afraid. They were afraid to spend money. They were afraid that if they invested and tried to expand aggressively, that they were going to be regulated and it was going to end up costing them a lot of money, and government was going to get involved, and it was just not going to be that profitable. So the fear is gone. At least it seems to have subsided. They're spending money. Investment as a percentage of GDP is at one of the higher levels it's been in years, which is a good thing. And we were talking about just before the break how corrections generally, I guess you didn't know that I was going to talk about that, but I was kind of leading up to why the correction is probably not going to happen anytime real soon. And I mean, a big serious correction. The 10 and 15%, that's a garden variety, by the way. That's not much. You can't, trying to anticipate that is really difficult. It's really difficult. And by the way, when you do that, if you get it right, you've got to get it right again. You have to do it twice in a row to get back in at the right time. And if you're not perfect on one or the other, it's going to cost you a lot of money. Okay, so that's why we generally don't like to do that. But the bottom line is we've got revenue growth that's really good, the best it's been in a very long time. Businesses are investing again. The expenditures as percent of GDP is nearing it's actually a much higher level than it has been in 8 or 9 years. That's a really good thing. In fact, you've got I think the statistics somewhere around 2 million jobs, relatively high-paying jobs, and some of them are very high-paying jobs that are going unfilled because we don't have the workers with the skills. So, and that's actually a smaller problem, but it's a problem that you like to have. You like to have more jobs than you have people out there because kids are graduating from college every year. And things are really, really looking up. On the big thing I was going to wanted to really talk about was how investors expect big corrections, and they don't think we've had one in a very long time period. And you know what? I don't know what you were talking about, because you look back at the fourth quarter of 2016, it wasn't huge, but it was almost 10%. You look in the last quarter of 2016, there was almost a 10% drop. And people forget at the beginning of 2016, it was one of the worst January. It was the worst January in the history of the stock market. And it had actually peaked out in November of 2015. So you get a correction that's almost 15%. So what the heck? Where are you getting your number? Where the reporters don't even care anymore. I mean, they just don't care. They will say anything to try to get headlines and or try to get readers. Because now they get paid on pay-per-click advertising or pay-per-impression. I would never do that, by the way. If you're a marketer out there and you're paying per impression, you need to stop that. I'll probably have a contract out on me by some of the people that sell that stuff now. But the pay-per-impression, that's when somebody goes up, when supposedly your ad shows up when somebody's on the website. You know what? That is incredibly difficult to track. You can track the click if somebody actually clicks through and goes to your website, and you can really measure how many people fill out a little questionnaire and send it back. That's really measurable. That's what you should do if you're doing the online advertising, the pay-per-click, or I would even take it one step further, because you just don't know. I don't know the I guess trust but verify, that sort of thing. Yeah. Anyway, long story short is I get off on these tangents and I forget, but I remember now. I was talking about the correction. So they've said we haven't had a big correction in an extreme long time. Well, how about the beginning of last year? That was a big one. And it started in October and it ended right around in February, October 2015, then 16. So 2016 goes and we don't have a huge correction. There was a small one in June. If I go from, that's about 9% or so. So that's not a full 10%. And then there was another small one that occurred September through November. And that was only about 7% or so. So we've actually only gone a little over a year, maybe a year and a half, without a more than 10% correction. That's a little bit unusual. So a 10% correction, but that's nothing. That is really nothing. Especially if you're in a balanced, let's say you're in a balanced account and you're 50-50. You have 50% short-term fixed income, 50% in stocks. Market goes down 10%. You'll hear it all over the media, all over the internet. It's going to be, Armageddon, because everything's Armageddon now. Everything that happens is the worst thing that could possibly happen. That's how you sell ads, by the way. So what I'm telling you is that you just have to not pay attention. Look at the actual numbers. You get a 10% correction, you should be looking at buying. And a 10% correction in somebody who's in a 60-40, if you're 60% stock, 40% bond, you shouldn't be down much more than 6% or so. No big deal. That is really not a big deal. And that can be made up very quickly. My feeling is that over the next few years, any corrections will actually be made up very quickly because the revenue growth is growing now, and there are lots and lots of new industries. Heck, we don't have enough people to fill the spots in the old industries. We've got the new industries coming out. What am I talking about? Well, you still got natural gas. You still got to have electricity that's being generated more with natural gas each month than it was the prior month. That's a change. You've got cars, electric cars that are becoming more and more common. Tesla still can't keep up with demand. They've released all their patents so that all the other companies and the 10 of the major car companies around the world have announced that they will have an electric car by 2022. You know why? Because they don't have to do the research. Because Tesla gave them all the research, all the patents, they released them. You can use it. They want everybody making electric cars or hybrids. That's a fuel cell car. That's runs on a derivative of natural gas, basically hydrogen. You can take hydrogen. You can take natural gas, take the hydrogen out of it, sell it in a filling station. They got a bunch of them in California. They're working their way across the country. So that's a big deal. That's a really big deal. That's not where it ends. The grid's got to be rebuilt. You look at all the construction that's doing on the bridges, highways and bridges. By the way, that money was allocated a long time ago, and it just wasn't released into the economy. And it was one of the things that you can thank your government for. They're really slow sometimes, especially when they have an agenda. We won't really talk too much about that, but it's good that it's happening now. It's good that the money's out there, that they're putting people to work. They're fixing the roads so our cars don't, our cars last longer. That's a really good thing. But anyway, back to the sales growth. If sales continue to grow at this pace, then stocks are exactly where they should be. If sales slow down, and they're maybe 10, 15% overvalued, big deal. It'll pick back up again. If you have a 10 or 15% correction and you're only 60 or 70% in stock, you probably won't even notice. You probably won't even notice that. And I think that's a good thing. In fact, if you're watching it that closely and you do notice, I don't think it'll be all that upsetting, particularly if you have one of the Bullington Financial Portal access points, the thing that we're doing for all of our clients. If you're a client out there and you haven't gotten your email yet, call me. Okay. It's just an oversight. Yeah, we're moving our offices about a mile away, so we got a lot of stuff going on. And it's about 1 mile from where we are now. It's going to be a much nicer office. I'm putting a little place in the office so you can come in and we can set these up for you, the financial portals. You'll be able to track all your stuff, not just the stuff that I'm managing, but you'll be able to track all your stuff in one place. And you'll be able to put real estate in there. There's a digital vault so you can store whatever kind of documents you want. If you don't have a scanner, we do. Actually, our scanners are really fast, too. And it's a really nice tool. That 10-minute retirement plan we talked about, I showed people how to use. I used a sample client there. Once you set it up, once you've played with it, it's a really good tool. You can go in and make changes. Let's say you decided you wanted to buy something, you want a major purchase during retirement. You can go in there and take that money out of your account and see how it impacts the probability of you running out of money. How cool is that? You don't even need my help for that. You might need my help learning how to do it the first time. You do it a couple of times, you're not going to need my help for that. Now, that's why we're doing it. It's an expensive program. I've subscribed to software as a service. Resides in the cloud. It's got really a high level of security. It's got alerts that you can set yourself. I can show you how to do that too. So I have mine set. If a transaction goes through above $500, I want to know about it. If it's below $500, I'll just look at once a week when I download all my transactions in one place, mind you. One place, I go to that one website, I can download all the transactions and all the accounts I have. And I get to see, and I get to go through. I can either do it online there on the financial portal, or I can download it to a spreadsheet and that's kind of what I like to do. Instead of having to go to 5 different financial institutions, I just go to one, download everything, and then I can look around and manipulate the spreadsheet. It's a little spooky when I see how much I spend at Starbucks, but but at least I'm aware of it, and that's kind of the key. You want to know what the chances are of you running out of money. You got to know how much you're spending now, right? And it's pretty easy with this program. It's really cool. I'm so excited. Yeah, it's getting to the point where the things that you really need are getting a lot easier to do. The things you really need are getting a lot easier to do. Keeping an eye on your stuff, it's never been easier. You can put your 401ks in there, your savings account, health savings accounts, the anything you can think of. You can put the value of a real estate. You can put your business values. If you don't have online access to update automatically, it's read only, by the way, so nobody can hack your stuff and do transactions or anything like that. It's a read only environment, as safe as you can get. Military grade encryption. So but you can see everything there, and when you're looking at everything, and it doesn't fluctuate nearly as fast as stocks do. Your net worth doesn't fluctuate nearly as fast as stocks do. I think that's a great tool. You go in and remind yourself, hey, yeah, okay, the market's volatile, but it's not too bad. Oh, look at that. I'm not even down. Sometimes you're up when the market's down. That's kind of interesting. So I think that's really, really nice. It's a great tool to have. It's a great tool to have. It's a good time to be alive. As far as I'm concerned, it's a great time. I can't wait for the self-driving cars actually to be really good. Self-driving cars, that's I can see my grandkids going, hey, Grandpa, what was it like when you actually had to drive a car? What was that like, Grandpa? I say, well, back in those days, I remember being a teenager and driving, that was back when they thought we were going into another ice age. Remember the big snows we used to get all the time? You didn't really drive a car back then. It was kind of like navigating. It was like you were in a boat, and it was kind of interesting. You see these television shows today where these Japanese guys are they call it drifting. Well, that was just Bill Bullington going to school in the 70s. Because the ice and snow, you had to learn to drive that way. You just had to learn it. There was no other way. We didn't have power steering and power brakes. Heck, I had a truck that had the gear shifter in the column, the steering column. Very few people have. The young guys don't even know what that is today. Yeah, and it's hilarious. So what's old is new again. But in the future, these cars are going to drive themselves. It's going to be safer. In fact, I like the assisted driving now, where the car is actually communicating and bouncing radar signals off the cars in front. And when you're going too fast, it automatically slows you down. Or if you get out of your lane, it steers you back into the lane that you're supposed to be in. Yeah, I think that is really cool. And traffic deaths are going to be down. In fact, when I was in, I can't remember actually what year this was. Maybe I'll remember it during the commercial break. You're listening to Bill Bullington right here on 1420 The Answer. I'll be back right after these messages. And we're back. Now comes the portion of the show that you really want to pay attention to. So if you missed this, go to iTunes or go to my website, get the last segment, and you want to listen to this part. Why? Because I'm going to talk about individual stocks. And I know everybody likes, well, not everybody, but a lot of people like that. A lot of people crave that. I run a small fund. It's very small. It's private. And I use this for about 60% of the money. 60% of the money that goes in the fund, I'm using these particular techniques. And I'm going to tell you which ones that I've just purchased or am thinking about purchasing based on basically the price movement and also the underlying fundamentals behind the companies. Typically, I'll only talk about one or two. And I'm trying to figure out how I'm going to basically get this out to the general, well, not the general public, but the people that like to listen to the show, longtime listeners, clients. I haven't really figured that out yet. So if you got any ideas, give me a call, drop me a line. I think that this is something that you shouldn't do with a tremendous amount of money because you probably don't have time to keep up with it that closely, but you can do some. It's not as risky as people think. In fact, one of the key ideas about this whole thing is managing the risk. Got to manage the risk. If you don't manage the risk is going to manage you. I'll give you an example. I think there were two stocks in the last 2 days that gapped down. They were both down more than 10% in the first few minutes of trading. Two stocks that I owned, okay? But if you combine the two stocks together, the loss to the fund was less than 0.5% and was offset largely by a lot of the other stocks. So think about that. That's pretty cool. That's what you really want to do when you're managing risk. You want to try to keep the risk as low as possible. You can't avoid it, but you can manage it. So you can't avoid risk, but you can manage it. And if you do a good job managing the risk, at some point in time, you're going to make a pretty decent return on your investment. So that's just kind of how that works. And so here's one of the scans I like to run, is I like to take all the stocks that have values, and I raised this. Well, actually, I didn't raise it. If I were you, I would raise it to 500 million. I'm going 250 million or higher. Why did I say I would go 500 million? Because a $250 million stock is not a real big company, and the share price can fluctuate really fast. So that's only something for people like me who can hang around there. Or if you have really thick skin, then fine. I'm not here to tell you what you have to do. I'm just giving you some advice, and this is America. Feel free to ignore it, just like I ignore an awful lot of advice that I've been given over the years. But I'll let you make your own decision, and I just want you to know what you're up against. The smaller companies tend to fluctuate a lot faster than the bigger ones do. So if you're going to invest in smaller companies, you just want to hold smaller positions. You still have to have stop loss areas. And those we'll talk about on a future show. I'm just going to talk about the stocks that I see here that have come up that look interesting to me. Okay, these are just stocks that look interesting. And what do I mean by that? Well, I mean that they're moving very fast. This particular scan I'm looking at looks at the stocks that are above a $250 million market value, which is like the minimum that a mutual fund can invest in typically. Your average mutual fund's not allowed to invest in companies smaller than 250 million. Most of them won't go below $1 billion, incidentally. So at 250 million, that's the benchmark. And there are roughly, I forget how many stocks there are. It's about 3,100, somewhere around 3,000, just a little over 3,000 stocks that have a $250 million market value. So I start with that group, and then I look at those stocks who are going up the fastest over that 3-month time period. And I'm just looking at, right now, I'm looking at the top 15%. Okay, so the top 15% over the past 3 months. And when I look at the top 15%, there are a lot of names in there. The next thing I'm looking at is that the stock is up 3% in a day. So if the stock's been doing very well and it's up 3%, that's a good sign that people are still buying, basically institutions or investors are still buying the stock. Because there aren't that many stocks in a given day that are up 3% in one day. So it's just I'm just getting clues here. I'm picking up clues as to which companies are under accumulation right now. Now, something I like to add is a price to sales ratio, and I set it pretty high. It's at 10. I don't want anything more than 10. The average for the stock market is 2. So if you're at 10, that's kind of nosebleed territory. And I just don't like to go higher than that. What you'll generally see in a company that has a price to sales ratio that's higher than 10 is a biotech company or a company that's brand new and has no sales yet. And those are riskier. So I just try to eliminate that because the others are volatile enough. Those are incredibly volatile. Those types of stocks can open 70 or 80% lower than they closed the night before. And I hate when that happens. So I just try to stay away from that. So here's what I'm looking for again. 3 months, they got to be in the top 15%, so they got to be going up. It's got to be above a $250 million market value. They got to be up 3% the day that it makes the scan, and its price to sales ratio has got to be less than 10. This is the scan I probably pick most of my stocks from. Occasionally, I'll do a 1 month or 6 month as well. And most of the time, these stocks will come up on all three, or some of the stocks will come up on all three. So anyway, that's what I'm working at, and that's what I'm looking at right now. And the first stock that comes up that I've owned quite a few times, you just talk about volatility. This one's called Live Nation. When you go online and buy tickets, this is not one that I own now. This is one I plan on buying again on Monday because I'm a glutton for punishment. I'm just kidding. I've been stopped out of it a couple times. It's been okay as a stock. I haven't made a lot of money, haven't lost a lot of money on it. But Live Nation, they sell tickets to concerts. I've purchased tickets from there before. And it was spun out of another company. I want to say Expedia, but I can't remember back that far. The bottom line is they sell tickets online. So online companies, companies that do businesses online have much higher profit margins than, say, a manufacturer, especially a manufacturer of heavy equipment. Their profit margins are a lot higher. So that's one of the things I really like about that. Now, it's price to sales ratio. Remember I said the market's average is 2? Well, the price to sales ratio on this one is 0.92. So it's got a lower price to sales ratio. I'm not sure. I'll take a look really quickly because I forgot. I look at so many stocks. It gets pretty tough to remember everything about every company, which is one of the reasons I like to use this company called Y-Charts for the fundamental data, stuff like sales and profits. And I'm going to go right there now. And I've owned this stock before. That's the other reason I didn't bother looking it up. Yeah, so you've got a price to sales ratio. Revenues were $9.5 billion in the last 12 months, and they were up 12%. So what do I know about this company now? By the way, the analysis I'm doing, I'm actually doing this live. Yesterday was Friday. I don't have to look at the stock market until Monday morning. So this is a live analysis. That stock was up 7% on Friday. Volume was twice its average daily volume, over 4 million shares traded. It closed right near the high of its day. It came off a sideways base that's about 6 weeks long, which William O'Neill loves. So if you're an Investor's Business Daily fan, you'll love this whole thing. This is a classic breakout pattern. Now, it's up a lot, and that's what they like too. It's actually not up over 100% in the past 12 months, so that's not too bad. But the valuation on a stock like this could go significantly higher when the price to sales ratio is 0.92 and the average is 2 for the industry, and this company's sales are growing by 12%. That is a logical investment. That's logical. This could actually be a longer-term investment. It's got all the characteristics of a longer-term investment. Here's where future growth comes from. It's this thing called inflation. You'll be paying more for a rock concert ticket 10 years from now than you are today. Why? Because inflation. And if you don't believe that, go talk to somebody who bought rock concert tickets 10 years ago. Prices go up. That's what happens. So a company like this who just sells the tickets, they have a built-in inflation rider. Sweet. That's awesome. Now, for me, if I buy it here at $43, if I'm able to get it at that price, I'm going to set my stop about 10% below my purchase price. So if it goes down 10%, I'm out. See ya. I'd say it's only good if it keeps going up, because that's what the goal is. And that's what this very particular style, this is an aggressive style of money management. And I'm managing the risk very well. I'm not going to have more than 5% of my money. And in fact, it's probably going to be about 2.5%. 2.5%. So if I get stopped out with a 10% loss on 2.5% of the money, by the way, if you're only putting 2.5% of your money in things, you can have up to 40 stocks. Fortunately, you won't need to have more than 20. I can't believe the show is over. Well, I'm sorry about that. We'll continue this. In fact, I'll start to do this at the last section of each show going forward. Thanks a lot for listening, everybody. I'm Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, good luck, and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420 The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.
Do you have sleep apnea? Are you tired of dragging your big, bulky CPAP device with you whenever you leave home? Yeah, well, I was too. That's why I'm so glad I called to try the Transcend Mini CPAP for 10 nights. I can't imagine living without it now. My Transcend is smaller than a soda can and weighs less than a pound. That's less hassle to carry than my shaving kit. Plus, I was able to add a battery pack that's as tiny as a deck of cards. But hey, that's not all. Transcend is FAA compliant too, which means I can finally sleep comfortably while flying. Heck, I can sleep comfortably anywhere now. So if that all sounds good to you, call now to give Transcend a try. You'll be glad you did.
Experience the life-changing freedom to sleep comfortably anywhere thanks to Transcend, the world's very first mini CPAP. To receive your risk-free 10-night trial, call now. 1-800-700-2131. Again, that's 1-800-700-2131. 1-800-700-2131.
This is Michael Medved. I'm here with Mike Stahl from Health Markets, helping folks find the right Medicare coverage. The news reports say that the rates might be going down.
The government projects the cost of Medicare plans will decrease this year. So you have to ask yourself, are you getting the best rate? Health Markets offers a free service with access to thousands of Medicare plans nationwide to help folks maximize their benefits and save money.
What is it people need to keep in mind?
Enrollment in the right plan is not automatic. With so many Medicare options, it can be confusing. My advice, don't go it alone. Get unbiased help to find a plan that may cost less and cover more with lower co-payments, more choices like dental and vision, and the freedom to choose your doctors. With the enrollment deadline only weeks away, it's important to act now. Our Health Markets Medicare assistance is free.
Thanks, Mike. This is Michael Medved for Health Markets.
For your free Medicare assistance, call 800-601-0289. That's 800-601-0289. 800-601-0289.
Hi, Ed Flash Ferentz here, inviting you to check out American Law Radio, now airing on the first Saturday of each month from 4 to 5 p.m. right here on 1420 WHK. Discover what's really going on in the legal community and in our jails. Hear discussions about and solutions to excessive force so often used by law enforcement. American Law Radio, the brainchild of Cleveland civil rights attorney David Malick, who says all citizens are entitled to civil rights for civil wrongs. Get the scoop this Saturday between 4 and 5 p.m. right